cost segregation, you could accelerate your depreciation. You could depreciate your property 3, 5, 7, 10, 15 years instead of the straight line 27.5 years.
I see.
At the end of the day, whether you use cost segregation or not, you got tremendous depreciation loss to offset against your regular income only if you qualify on certain income level. So let's discuss that.
I see.
Yeah, cost segregation, okay, using the same property. At the end of the day, when you saw cost segregation, the strategy that justify you pay several $1,000s to a cost segregation company, the property got to be at least $500,000. If the property is less than $500,000, the tax benefit derived is not beneficial to hire
That's good to know.
Yeah, that's good to know. If you buy a cheaper property, don't bother with cost segregation. Just go do the straight line 27.5 year.
Sure.
But using cost segregation, at the end of the day, you're getting approximately $28,000 because you're accelerating your depreciation,
Right.
these items that we talked about. So 28 grand instead of 15 grand. So they'll give you more tax benefit that can exceed the cost of hiring a company to do it for cost segregation. So again, see, so these two passive losses you can claim against, because if you make less than 100 grand, the entire passive losses right here, almost 12,000 using straight line depreciation, or write off 24,000 using cost segregation. If you make $100,000 or less, you can get the entire passive losses to be deducted up to 25,000.
Okay.
Against your active income. Okay. If you make more than $150,000, and a lot of our investors from California make more than $150K. So the question is, if you make more than $50K, you cannot deduct any of the passive losses that are more than the gross rental income that you're collecting. The passive loss limitation rule is such that all your passive losses cannot exceed to the extent of your passive income gains. All right. So if you make more than $150K, you can still get the taxes and mortgage deducted fully against your gross income for your property. You cannot offset the excess of the passive losses against your passive income because for whatever reason. So it does not mean that you should not take the depreciation. It does not mean you should not take the straight line depreciation. It does not mean you should not do the cost segregation. You can still do it, spend the money to do it, especially when you buy a higher cost property, 500K or more, right? So if you make more than 150K, go ahead and do it. Do the regular depreciation, do the cost segregation, because you cannot claim current year passive losses against your active income, which is ideal, but you can carry forward any excess. You can carry forward any excess against future passive income, against future rental properties, gross income, and reduce taxes from your other properties because of the suspension of the excess passive losses if you make more than 150K. Did you follow me so far?
I see what you're saying. Okay.
Let me give you an example, okay? I have it right here. Here it is. The earlier property, the fourplex, you're getting either $12,000, not on this tax return. You're getting $12,000 on a non-cost seg, or a $28,000 on a cost segregation, right? On the fourplex. Now, if you make more than 150K, you cannot deduct. You can still deduct all your expenses if you make more than 150K and the depreciation, as long as it does not exceed the gross income, which is the passive income. Okay.
Got it.
If you have excess, then they have to be carried forward, suspended indefinitely to apply to the subsequent year's passive income. So if subsequent year, if the suspended passive losses, if you make more than 150K, if you have no other passive income to offset, then don't do a cost segregation.
Okay.
Unless you have a goal of buying more than one rental. The other rental, in this case, the other property I'll show you, the one over here, this Niagara Falls property, which is right up here, right here. Okay. You buy this property, have achieved very good cash flow and all that. The depreciation is low, but you still get a real cash flow annually at the end of the first year is $4,200. So very good cash flow.
Sure. Yeah.
So do a regular straight line depreciation, because this is a low price point. You're not going to pay a cost segregation because economically it does not make sense, as we discussed before. So you add up this single family home in Buffalo, Niagara Falls, similar to the home you purchased, on paper, you're getting an annual depreciation of $2,500. Everything the same. Annual gross rent minus your expenses. Pretty simple stuff.
Sure.
You get additional 2516 of paper depreciation amortized over 27.5 years.
Makes sense.
At the end of the day, you have almost $12,000 for expenses. Expenses deducted from your gross annual rent, $14,400 on that little nice high cash flow single family home, $14,400. Today, you have $2,459 of passive losses.
Losses, right?
You
Okay.
you can offset that against your active income from your W-2. On paper, on a tax return, the IRS think you lost money on the property on this particular rental. But in reality, you make tons of money. Why you make tons of money? Because you make annual net cash flow of $4,300. Then you make principal reduction of $674. Then even if you get a 2% annual appreciation at the end of the first year, 2% multiplied by the purchase price, you're still getting at the end of the first year appreciation of $1,730, right? You add on annual net cash flow,
Right.
principal reduction, and first year appreciation equity growth equals 6659. Gross added income divide 6659 from the down payment you put in, a measly 25K,
Right.
equals total first year return of 26%.
Right.
Total. Now think about it. This 25% is before the $2,500 of depreciation you got.
Right.
So if you I know it's hard to calculate, especially on the software. The $2,500 of paper loss you achieve, you could plug it into this number somewhere over here. I don't know which number. You could make the argument that the $2,600 paper loss on this particular property will give you more than 26%. Will give you maybe 35% total ROI at the end of the first year. Am I right or wrong?
Yes. Yes, that makes sense. Yeah, I understand what you're saying.
Yeah.
Wow.
Similar. Yeah. Any questions?
No, it makes a lot of sense. There are no downsides to investing in property, really. When you look at the overall, those 4 pillars, the benefits to owning property.
Absolutely. That small purchase price of the Buffalo property, you have 6 of those rentals. So imagine you already have a lot of cash flow from your 6 rentals.
Absolutely. Yes.
And you claim a lot of equity appreciation during the pandemic. You bought it 3 years ago, the best time to buy. But in addition to that, you're getting a tax benefit. Your return is like 30% or more total return each and every year on each one of your 6 rental property you purchased 3 years ago. Make sense?
Absolutely. Yes, totally.
Getting back to the original 4-plex pro forma that we discussed right here. Now, without the $15,000 depreciation or the straight line depreciation on this 4-plex we originally discussed, and if you use the cost segregation, which I highly recommend for most people with high income, we're getting a $28,000 depreciation. So that would add this number, this total return is not going to be 28%. It's going to be like 35 to 40% if you quantify the $11,922 of net passive losses on this particular property without the cost segregation. Hopefully, I'm not confusing people.
It's a lot of information, but I think people can go back and watch the video and then just make sure you have a good tax accountant that you're working with.
Exactly. So let me prove my point, right? So any kind of property you purchase, you have to go through the passive loss limitation. It doesn't matter. We have not even discussed the professional tax status, which will be another video, which is discussed next week, okay? The Real Estate Pro, IRS definition of Real Estate Pro, which can blow your mind. But we're just going over the rule of 100. If you make 100 grand or less, you can deduct up $25,000 passive losses against your active income.
Right.
If you make more than 150K, it'd be great if you make 150K, 300K, 500K W-2. You can do this. You can apply the same methodology that I'm teaching everyone. All right. So over here, even if you make 150K, the $11,000 that you cannot claim since you make 150K, because you have to carry forward the suspended losses. The carry forward. Well, look over here, Julie. The carry forward of the passive losses carry forward into the future years from the subject property, the 545K property, the 4-plex. If you make 150K, you cannot deduct in a year against the active income. You carry forward. You know what? The carry forward component, can offset against the other property's rental income.
I see what you're saying. Yes.
Yeah, because
Mhm.
other properties, if you buy the right good property, the cash flow properties, for example, in this case, Niagara Falls, as I discussed right here, Niagara Falls right here, okay? Yeah, you're getting some write-off. And then Jacksonville, Florida, I took the liberty of using
Oh, okay.
one of my Florida builder, that $989,000 new construction fourplex, which is trigger $88,000 rent, right? And all the
Mhm.
expenses and the annual depreciation. But the
Right.
carry forward of losses, if you make more than 150K, a lot more, doesn't matter. The
Mhm.
carry forward of passive losses can further reduce this gross income or your other rental property subject to taxation. So you can add on the passive losses, doesn't matter, whatever, 5 grand, 10 grand
Mhm.
more. So you can have more write-offs, you can pay less taxes at the end of the day on your other rental property.
I see what you're saying. Yeah, that makes sense. That makes sense.
Yeah.
Mhm.
But if you have no other rental property to take advantage of the suspended carry forward of losses, that is not the maximum strategy. You have to
Mhm.
find some other way to create passive income in other ways like syndications or I couldn't come up with other passive income from other assets other than rental properties. Other passive income could be portfolio income, interest income, dividends. I have to do
Right.
more research on that. But at the end of
Mhm.
the day, even if you're not a real estate professional tax status, claiming deductions, straight line 27 and a half year, and I'm gonna conclude everything.
Mhm.
And all that is and if you make more than 150K, still go ahead and do cost segregation if you have several property you intend to buy, a triplex, fourplex here and there, do cost segregation and do the suspension to carry forward losses to offset against rental properties. One more thing I failed to discuss, our South Texas, as we conclude this, we have a more real track record because a number of our investors purchased the fourplex
Oh,
in
very good.
South Texas.
Mhm.
And I know it's slowly, but it's a three-pronged strategy. But here's my takeaway about the South Texas fourplex is a trifecta. What I mean with trifecta is you can convert out of the 4 unit, and some of our investors have done so already. You can
Right.
convert uh, three of the units. You can use it as long-term rent, and
Right.
one or more unit you can use short-term rental or
Mhm.
mid-term rental.
Mhm.
So it's
Yeah.
the fourplex is a multi-pronged strategy,
That's
and
really
uh,
that's a good deal right there. Yeah.
yeah,
You could we've talked about the midterm and short term and other videos, but you could do that one complex with multiple strategies.
exactly. Just one building, one fourplex complex. You're right.
Mhm.
You can every year you can pivot. You can convert one
Right.
of the 4 units into short-term rental,
Mhm.
or mid-term rental, or long-term rental. This is no other market that I know of. Okay, I know. Look, I'm a little bit subjective. I'm a little bit biased, of course, but
Mhm.
what other market you can buy a brand new fourplex at such an inexpensive price, relatively speaking? You have multi-dimensional ways to create
Mhm.
different strategies. Not
Exactly.
only income property, just to recap, not only income property give you multi-dimensions, cash flow, passive income, tax benefit, equity growth, loan pay down, and all that. Another multi-dimensional aspect of the 4 unit, it give you multi-pronged and entrance and exit strategy,
Mhm.
MTR.
There you go. Mhm.
STR, LTR, meaning long-term rental, medium-term rental. And medium-term rental will give you typically, if you do it right, give you 50% higher gross rent than a long-term rental, comparatively speaking.
Right,
And a
right.
short-term rental, if you do it correctly, you can get 100% more rental income than a long-term rental, or more, or 50%
Right.
more in monthly income than a mid-term rental. But one final thing we didn't mention, you can self-manage your LTR, MTR, or STR in this
Right.
market. We have teams on the ground, property managers on the ground that
Mhm.
can help you manage your LTR, MTR, and STR. Why?
Right.
Because
Right.
we already have the beginning of a track record. We have seen what's
Mhm.
happening on the ground recently. I have several
Right.
of my investors who are, through my guidance, they are
Mhm.
doing MTR and STR, and they're
Right.
having success, beginning of a
Yeah.
success. So this market have a lot of future potential because it's a
Mhm.
emerging market. Things will get better in all aspects of LTR, MTR,
Mhm.
and
Mhm.
STR. Look, this video is longer than usual, so I'm gonna cut off just right now. I'm gonna conclude this. So Julie, what's your takeaway from this multi-pronged strategy which I just went over?
Oh, wow. You talked about so much, but I think that your clients and your audience needs to understand that there are just multiple ways to take advantages. There's multiple benefits, I should say, once you take advantage of getting involved in real estate investing. So like I said, most people only look at the cash flow. I can honestly say that was myself. When we first started, I was only interested in the cash flow. But I had no idea that there were so many other benefits. And now that we've owned them for a few years, we have been able to take advantage of those, the leveraging of the properties, the tax benefits, all that stuff. So it's a much bigger picture than I think initially most investors look at. So I would encourage your listeners, watch this again. If you own property, or if you're thinking about owning property, get with a good tax advisor, so that they can help you walk through that process, and then get with a good mentor that can help you take you through the actual mechanics of investing.
Very good. Very good recap. I don't need anything else for me to say. Other than that, again, it's so much. There's so much great content. It took longer than usual. I apologize. Be patient with everything, but digest the content on your own once you review the video. But other than that, if you receive any value from this podcast, please like and subscribe and comment below. And then also subscribe to my website. Put your email on there so you can so we become a free member of our investing community within our network. So every single day, through your email inbox, you will receive some similar or even greater contents about real estate investing, all aspects of real estate investing. Mom and pop investors, anybody can do this. We cater to beginners and experienced investors also. Just go ahead and do that. Thank you so much for watching. Be patient with us. Thank you, Julie, for
this is great.
Thank you so much. I'll see you guys next time. Bye-bye.